Hello, friends that live within the internet. My name is John, and in this video, I'm going to be sharing some tips about how you can get going investing within the stock market. Now, the videos that I normally do are more on web development and productivity. However, a lot of people actually ask me advice about investing in the stock market. Now, the reason for this is because I've been doing it for about 15 years. I'm not an expert by any means, however, I do fairly well out of it now. So what I'm going to do is share some tips and some experiences that I've learned throughout the course of my trading career. There'll hopefully be some really useful things. Now, for example, my wife was really scared of investing in the stock market. Now she has been investing and she's doing much better than if she'd ever put any of her money sat in a normal savings account. And if you're sat there watching this and you have money in a savings account, then this video is for you because it's really key about understanding what you need to do, and actually it's probably not as risky as you think. However, it's all about having the right mindset and doing things consistently. So if that sounds good to you, stick around. I'll cover everything that I know. If you like this kind of video and you want me to do more types of investment videos, please leave some comments below because there's quite a bit I could probably talk about. Also, I do weekly YouTube videos on web development and productivity. If you haven't already, hit that subscribe button because you want to be an absolute legend. Anyway, let's get on and talk a little bit about investing. Let us kick things off by talking about what I consider to be the most important thing you need to get right before you start investing, and that is your mindset. Now, this is the thing which is going to lose you or make you loads of money. And what do I mean by mindset? Now, I don't mean you need to have the best education. You don't need to know everything about the stock market, every single company. You just need to know what you want yourself. And this is key. And if you don't get this right, you're going to lose money. So this is the thing you need to understand. So we all know that the stock market goes up and down. We've just gone through COVID and the stock market crashed. We all know that the housing bubble in 2006, there was a massive depression, the stock market crashed. And what tends to happen in these situations is people tend to buy high and sell low. Now, we all know the classic mantra is that, we should be buying low, selling high, making loads of cash. However, if you look at most investors, they actually do the opposite. And what do I mean by this? So imagine, 5 years ago when Bitcoin was running high, I completely fell into this myself. Is everyone was going, Bitcoin, Bitcoin, you need to buy some Bitcoin, it's the best thing. So I put, a little bit of money into Bitcoin, and then what happened? 6 months later, it crashed. And then when it was crashing, I sold on the way down. So I bought it at a premium and I sold it at a discount price. And that is basically how you lose your money. Now, the reason why I did this is because I didn't really have a game plan for my investment. Now, when it comes to the stock market, I do this for my retirement. So when I'm, 50, 60, I want to be able to cruise the world, go on cruise ships, go on nice holidays, and I want this all to be funded by this money. So if the stock market goes up and down in a certain week or a certain year, it doesn't really make a difference to me, because as long as over the period of a year or 12 months, it's slightly going up, then that's the main thing. And that's what you want to sort of get your head around, is that you want to be making about 10% every year. However, there's going to be times when it's going to massively drop and you'll lose money. And there's also going to be times when you're scaling high and you can make loads of money. However, what you want to do is just get your mindset right by understanding why you're investing, because you really need to have the confidence to be able to weather the storms. Now, I know this is much easier said than done. So I remember talking to a young lady that I used to work with a few years ago. She was asking me some tips how she get invested. And I said, what you need to do is follow the process that I'm going to lay out in a little bit. And she was like, yeah, but what happens if it goes down? I don't want to lose £200. Which is a fair, thing. If you're not making that much money, losing £200 would be quite a big deal. However, if you follow the system that I'm going to outline, the system that I followed, you could end up having, say, £100,000 in the stock market. And if the stock market drops 20%, you're going to actually have to take the hit of, you might be losing, £20,000, £30,000 in a single month. And that is actually what happened to me. When COVID hit, I lost about 30 grand in 1 month, about 10 grand in another month. I was riding high. And then, 3 months later, you're like, I've lost loads of money. And at that stage, that's the point when you don't want to sell. Actually, at that point, that's the point when you want to double down. So after losing loads of money, taking all that hit, all that panic, or people going, don't buy stocks, don't buy stocks, that is the time when you actually wanted to get the biggest discount you can and double down and buy stuff. However, as I said, it's really easy to say this theoretically. When it is your own money, it really does sting when you've lost like £20,000 overnight. And that is one of the things you just need to get right, is understanding where you are, what your game plan is, why you're investing for this money, and then understanding that you just need to stick to a plan, and having that plan and a consistent plan that's going to like weather all the storms, and that's going to be far more important to you than just understanding the latest tip or trick, which is going to make you an extra couple of quid here or there on a year basis. Having that plan and having that long-term strategy is key. An index tracker fund is the easiest way for people like you and me, home investors, to get started within the stock market with the best chance of making money. Now, again, there's loads of information about this. There's whole books written why this is a good thing. Can't really cover it in a video. However, the important thing to know about index tracker funds is the management fees. Now, as the name implies, a tracker fund basically tracks a certain sector. So it will track, say, the top 500 most profitable countries in America, or it might be the most profitable IT companies. And that's basically what the S&P 500 is and the Dow Jones index is. Now, one of the important things and why index tracker funds are really popular and most profitable for you is because computers basically can simply track which companies to buy and sell. There's no man in the middle. There's no one who needs to figure it out. Now, if you put all your money in a hedge fund or a fund which is basically managed by somebody else, there will be a load of fees. Now, on the screen, you can see that the fees for the Fidelity Index World Class is 0.12, which is really, really low. And if you look at all of these index tracker funds, you can see that the charges that they use for investing are super low. Now, if you have a look at a managed service, you might have a 3 or 4% management fee which gets taken out of your pot every month, and this is basically going to eat into your profit. So no matter how well the fund is, you're probably going to do better off investing in an index tracker fund because of this fee. So paying less fees is basically much more profitable. So what we want to do is look at investing in an index tracker fund. I personally suggest that you pick one which is based in America, because from my experience that's been the best ones for me. And what we want to do is think about when we're going to invest in these indexes. I want to talk to you about two really important key topics that anyone investing in the stock market needs to understand before they get going. Now, the first one of these is called the dollar cost averaging, or what I like to call DCH. Now, the important thing about dollar cost averaging is timing. Now, a common thing that's been said to me many times over the years is, say, like, I've got £1,000, I want to invest it, but I don't know when I should invest it. And this is one of the things that dollar cost averaging will help you understand isn't that important. Now, one of the problems when people try to invest is they want to invest at the optimal time. You want to invest when things are low, and then you want to sell when things are high. However, trying to wait for the market and trying to gauge when's low and when's high is a bit of a fool's errand. Like, none of us can predict the future. None of us know what's going to happen when things go up and down. So what tends to happen is people who try and time the market, most of the time they often lose. So what will happen is you'll put your £1,000 in, the market will drop, and then people go, I told you investing in the stock market was a silly idea. I've lost, say, like £200. I'm selling it. I'm selling low, so I'm going to lose a load of money. I'm never doing this again. It's stupid. And this is where dollar cost averaging comes in. So with dollar cost averaging, what you do is you commit to spending X amount of money, and you invest basically the same amount and the same time frame every year. So it might be you invest, £50 every week, or it might be you invest £200 every month. However, the important thing is you do it basically on the same date every single month, or the first of the month. And what happens is during your investment, sometimes the stocks will be up and you'll get a higher price, sometimes it'll be lower and you'll get yourself a bargain. However, the average over the 12-month period will be better than you trying to time the market. Now, if you've got millions of pounds and you're on Wall Street and you're all real clever and you've got a big team around you, you might be able to time the market. However, for numbnuts like me who haven't got the time to research everything, basically dollar cost averaging is your most efficient and effective way of investing to make sure that you get the best investment possible. So what you want to do is set up a monthly automatic payment to your index tracker fund, and you basically want to invest a small amount, or the amount that you choose, every single month. So say the first of the month, you're going to have £1,000 going out your account into the index tracker fund. And this is the optimal way of getting the best dollar cost average for your investment. The next really important concept to understand when it comes to stock market investing is compound interest. Now, there's loads of great videos out there which explain this in really good detail. The important thing to grasp is it's all about timing. And the longer that you invest in the stock market, the more money that you will make. So what happens is, say you're investing £50 a week when you're 18, by the time you're say 60, you'll probably have about £4 or £5 million if you just invest in a stock market index fund for the rest of your life. That's all you need to do to become a millionaire. Super simple. However, most people will not do it. Now, if you think, actually, I'm going to wait until I'm 50 to make that same 4 million, you'd probably have to invest something like 10 grand every month or some stupid amount. And that's the important thing to get here, is that the sooner that you start investing, the more money you make. And it's really important to allow your money to grow. And this is because the way that we grow our stocks accumulates the older we get. So think about it, like every month you're going to put £1,000 in. At the end of the first year, say you make 10%, that's £1,000. So now you could either spend that money, go and get yourself, have a nice few beers, go on holiday, get sun, or what you need to do is reinvest that money and buy more stocks. Now at the end of year 2, you're going to have say 20%. And then if you reinvest that, by the end of year 3, you're going to be able to buy more stocks, and so on and so on. And the smaller you start, it doesn't really make a difference, because when you hit that pinch point, and as you can see on that graph in front of us, say like £400,000, £450,000, at that stage, you're going to increasingly get more and more wealth. So it's going to take you much longer to get from 0 to 100 than it might do from $500,000 to $1 million. And that's the whole point, is that the longer you start doing this, the faster your money will grow later on. So it's really important to understand compound interest, go out and research it, and understand that when it comes to investing, don't put it off to your 30s or your 40s. Start investing this week, today, tomorrow, or whenever it is. Just do it straight away. Consistently think about dollar cost averaging by putting money in once a month. Put your money in an index tracker fund, because that's going to give you a way to spread your bets, and it's going to decrease your risk. And then you want to do it as soon as possible. And this is the best way for you to invest in the stock market so you don't lose any money. Also, when it comes to crashing and stuff, don't sell stuff, just continue, put your money in, month out. This is the process I've done. It takes me probably like an hour, 2 hours every year to set up. And as I was saying, some months I'm making more money now than when I'm actually working a 9-to-5 job. Super simple, anyone can do it. Let us quickly recap where we are, and this basically summarizes my investment approach that I've been using for the last 15 years. It's done me well, and I'm pretty sure if you do it, you will find some positive results as well. So we've talked about the index tracker fund, and there's 2 really key things that we like about the index tracker fund. First, we're diversifying our portfolio because we're investing in many companies rather than one. So this means you don't need to worry about picking the right stock or a single company going bankrupt. We're mitigating the risk because we've got our money in loads of companies. Now, because these funds are managed by computers and not people, the actual charges and the management fees for them is significantly lower than other types of investment. This means that over the period of your investing career, you will be saving thousands and thousands of pounds. So this is why an index tracker fund is really key. And Warren Buffett, the world's most famous investor, this is the approach that he recommends for everyone out there who's a hobbyist investor like us, because otherwise, you need too much knowledge, it's too complicated, or you have to pay for someone else. And as soon as you start paying for someone else, you're losing money. Now, we also know about dollar cost averaging. We don't want to just bung in these massive lump investments like once or twice a year or once every 10 years. What we want to do is pay money in a consistent time frame. So every month, the first of every month, for example, we're going to put in our £100 and we're going to invest it in our index tracker fund. It's going to come out of our bank account straight away. And then you're just going to invest in it, and you're going to leave that going month on month, year on year, and eventually everything will accumulate. Also, we know that the timing is really important. The longer you leave this, the less money you'll make. Now, it must be really easy to go, I'm only on X amount of money, I don't have any spare money at all whatsoever, I've got credit card debts, I've got blah, 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 I've got blah, blah, blah. The thing is, there's always going to be an excuse why you don't do this. And the important thing is just to start, so start today. So even if you haven't got that much money, just set aside £50 every month and invest it in an index tracker fund. And what will happen is eventually you can grow it and grow it and grow it. And that's basically what I did. I started off investing £50 every month, and now that's snowballed into, a lot more. And that's basically the whole summary of how I invest my money. As I said, it's been working really well for me for 15 years. Now I will finish with one final tip for you, because I think this one is also kind of key. And let's talk about that now. The final tip that I would like to leave you with is just about the nature of how intertwined our global economies really are. And this is something that I wish someone had told me when I started investing, so I'm hoping this is a good tip for you. Now, when I started investing, I put money in the UK stock market because I'm English, I'm patriotic, and I was helping my country out. Now, after a period of time, I was reading some more books on finance, and they're all talking about, diversification and then making sure you don't have all your eggs in one basket. So even though I had money in an index tracker fund in the UK market, I thought I'd have another bit of cash in the US stock market as well in a different index tracker fund. This way, I've got my money in 2 different countries and I'm safe. However, I did not realize how intertwined the nature of the global economy is. So there is a great video by Ray Dalio called The Economic Machine. I recommend you have a look at that. I'll link to it below. However, let's look on the graph in front of us. Now, if I go to the S&P 500, which is an index tracker or a fund within America, you can see that around 2016, when there was the big housing price bubble, that everything massively dropped. Now let's have a look at the FTSE 100, which is the UK equivalent. And as you can see, when we had all those problems in America, the English market completely crashed as well. And this was one thing that I just didn't really think about. I thought my money was a lot more safe than it was. However, because you have your money all in one basket, just because there's a problem in America, pretty much the markets in the whole of the world might also be affected. So when it comes to your investing choices, you might want to not put all of your money within the stock market. You might want to have, say, £10,000 in an emergency fund. This means that if everything is going really badly and you need some money, you're not going to have to sell it when everything's low. Now, the other thing which is really useful to note is this graph of the S&P 500. So as you can see, when the big economy and the bubble hit in 2006, 2007, whenever it was, you can see that actually in this dent of stock market ups and downs, it was actually quite small. However, at the time, this was the end of the world and everything's going to go. But as you can see, it's just a small little blip and things have continued to move up. Now, this is the other point I want to make. Look at the UK stock market. If you look around here, it's pretty much hasn't moved in 20 years. So I actually had a lot of money within the stock market, and this money hasn't really grown. And this was a bad investment for me. I still haven't sold some of it. I probably really should have. But also, not all indexes and not all countries are born the same. So what tends to happen is loads of people just put their money in the American markets. We all know people like Google, Facebook, Apple. So if you're going to go and invest in a fund, I would recommend that you probably look at some of the bigger funds which are in America, because one, if America has a problem, all the other markets are going to be affected. And 2, that's where most of the money is. So just investing in America is probably a safe and good idea. And that concludes the end of another episode. I'm hoping that within this video, you have found some inspiration and you've learned something new. I'm hoping that there's a few people out there who might go out and actually invest in the stock market. For me, it's one of the most beneficial and valuable things that I've actually done. I know that it's really scary at the beginning, so I'm just hoping to show some people that by following a simple process, you can really make it work for yourself without that much risk. Now, the topic of this video is very different to what I normally do. If you would like to see some more financial tips and tricks within this channel, then please leave a comment or a like. Just simply say more of this type of content as a comment, and I'll do some more types of videos like this. I've got plenty more that I could talk about, and I could give you some more tips. Otherwise, if you haven't already and you like this content, please hit the subscribe button, the alert button, hit that like button. Like basically tricks YouTube into sharing my video to more people. So I very much appreciate that, and it takes no effort on your part. So be a legend, do those things right now. Otherwise, I hope you have an amazing day and happy coding.